Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
When we're looking at measuring pace or momentum, we're looking at one particular move. Let me pull up a drawing tool here, such as A, and comparing that move to the previous move. And what you can see is that overall the momentum or the pace of this pullback or correction marked here as A is much more gradual than that previous upside move. Now, when you have a slower than average move or a slower than average correction, there's a higher probability that the breakout from that correction is going to be stronger than that correction itself. So since A was a more gradual correction, the chances are high that the breakout's going to be stronger than A was. And that can lead to a very solid upside move. When you're looking at options, that's going to give you an indication that you can hit target levels more quickly than something that has formed a bit of a steeper pullback and might take longer to reach a larger target objective. For instance, in C, we have a stronger pullback than we saw on that correction on A. And a lot of times the result can be a shift in momentum where the breakout or the continuation is slower. It takes longer to hit price objectives that are closer than it would if the correction is more gradual. Now, C is still a slower than average correction, and it's also pulled back less than half of that previous upside move. So it did not necessarily need to have a slower reaction or slower breakout than shown in B. However, in this particular example, we're looking at a change in momentum or a change in pace. But I want to make that clear to you that if you're newer to reading pace or momentum, one clue that you can look at is when there are more than a 50% correction, for example. If C had corrected more than 50% of B, then the chances increase that it's going to have a more difficult time breaking that previous high, which would be the high here, where B and C kind of converged. So we see that example where it broke down at E. The slower upside momentum has now shifted, and we have a stronger breakdown in E. And as it bounced, it created a retraction of more than 50%, coming back into that breakdown zone from D. And when you have a V type of bottom like this, not only does it increase the chance that this could be a slower reaction coming off of that, but it also creates a higher probability of a trading range. In this case, we had another V. In this case, it's an upside down V, but that creates this larger trading range where the overall momentum has now shifted to a sideways range. When you're looking at pace and momentum and you see a lot of back and forth action, you can actually take that trend channel where you would take the highs and the lows of that channel where you have the back and forth action, transect that to give you an idea of what the pace or momentum move of that congestion is. So in this case, we now have a stronger uptrend and then a shift in momentum where the momentum has now developed more of a sideways type of trading range, which then creates a higher probability that that trading range is going to break lower. This is made even more likely when within this trading range itself, we have another shift in momentum, where we have a strong breakdown on I and then a slower, more gradual pullback or correction marked here as J. So not only does that larger time frame channel here suggest a shift in momentum, but we also have a shift in momentum within the smaller trading range or trend channel itself. So all of these point to a highly favorable condition for a breakdown. And I wanted to look at these overall trend channels, which is something that I don't do a lot when I'm giving this particular segment of this presentation, because we're going to see this come up and come into play when we look at several of the examples that I've compiled for this particular presentation. Now, when we look at the next chart, what I want to look at is how pace and momentum shifts and how these momentum shifts create high probability strategies or price developments. What we're seeing here in this particular example is that we have slower moves marked A here, stronger breakout with number 1, more gradual correction marked B, stronger breakout marked 2, but now we have a shift in momentum or a shift in pace at this high. As 2 came to an end, it didn't just lead to another correction or another pullback. It actually corrected higher, but with a change in momentum. So we now had a slower upside move than that upside move initially began as. This resulted in this turnover or reversal pattern marked C. For those of you that are looking at trying to create reversal strategies or quantify reversal strategies, one of my favorite reversal strategies takes place and looks a lot like this pattern development marked 2 and 3. But if you look within this third move right here, what you will see is 3 individual highs within that new channel. By creating those 3 individual highs, you have the highest probability chance of getting a stronger breakdown or stronger reversal pattern developing. In this case, the reversal came back into this congestion where the pace change began. You can see the end of that marked here at C. And then the stronger momentum move on the downside experienced a shift in momentum once again marked 4. This allowed for a longer correction to that upside move. Let me clear this here so you can see a little bit better. Where we had this larger upside move here, and now it's started to hug that lower trend channel, which creates another high probability setup to lead to a reversal pattern marked here as D. And then we see the same sort of action again where sideways overall momentum or corrective action leads to another breakdown pattern. This particular pattern is one that I call an avalanche because it typically follows through very quickly. Oftentimes these lows here are going to take place along a moving average, most commonly the 20-period simple moving average. So if you keep an eye on that, that's going to give you a really good strategy to look at developing. And often they also have 2 to 3 waves of upside within that congestion along that moving average.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.